Well, shifting focus to crude, earlier this morning, OPEC said that it sees no further rise in demand for crude this year. The group's closely watched monthly report says that oil oversupply should ease in the next 3 quarters. We also got data from the U.S. Energy Information Administration that shows that crude inventories fell by 6.8 million barrels in the last week. And that is much more steeper than estimates of a fall of 1.7 million barrels. Crude prices rallied hard in early trade, but then they've given up some of those gains. And as we see right now, Brent at 65.37, a gain of less than 1% now. NYMEX, however, rallying over 1% and very close to $61 a barrel. For more on what to make of the movement in crude prices, I'm now joined by Philip Gotthelf, President of Equidex. Philip, thank you so much for being with us on the show today. Lots of statements coming in from the EIA. Apart from the drawdown in stockpiles that we've seen for the last week, they are also suggesting that U.S. production might not be as robust as what was previously envisaged. What do you make of all the statements out of the EIA over the last 24 hours?
Well, certainly the EIA has been releasing some mixed messages regarding the amount of oil that is available. If you compare them historically, we're still looking at very large inventories relative to usage, which is one of the reasons why the August contract in Brent is being held pretty much below $64 a barrel, which was the high that was made in May. If you take a look at the chart technically, crude oil is trading between, say, $58 a barrel and $61 a barrel, and there's no indication in the fundamentals that there would be a major breakout. Some people calling for as high as $70 or $75 a barrel. There's nothing in the technicals that shows that. There is some increased tension over the Middle East situation. However, this morning, all the newspapers were full of articles about how the United States is stepping up its presence in Iraq in its fight against ISIS. And the refineries in Iraq have been reasonably well protected for the moment.
Philip, I get your point on technical, so I guess as you suggest, the range is 58 to 61 for NYMEX oil. But what about fundamentals? We've heard commentary from OPEC. They choose to stay the course. They're not cutting production. And then all the commentary coming in on the amount of U.S. oil which is out there in the markets. What's your sense on just the sheer amount of supply that's right now in the system?
Well, there's a very large amount of supply in the system, and we've seen that the global production of liquid fuels is at a historical high, only being exceeded once previously, and that tends to provide what's known as the crack spread opportunity, which means that one could sell the products, which would be heating oil and gasoline, and purchase crude oil in anticipation of those spreads coming in. But the reality is that if there's too much supply of products, eventually the demand for crude oil subsides, and this is why most of the market watchers on the cash side have been exiting the market. For example, just last week we heard that it was the largest exit of positions in the crude oil ETFs to suggest that the enthusiasm for the long side of crude, at least momentarily, is no longer there. So you don't have as much of a speculative interest as far as demand is concerned, and you have a problem with supply. Now, the United States is certainly a large factor now that it supplies fracked oil, but we can't ignore other areas that are expanding production, most notably in South America. We see relatively impressive increases in Colombia, and also additional crude oil supplies on the increase, on the rise in Brazil. And so it's not just the United States that's contributing to the flow of oil. Other suppliers that recently have come to the market are also in the game, and this is why OPEC is trying not to become overly ambitious at this moment.
So I take your point on U.S. supply, but let me again read out two of the EIA statements to you. They say that exports should see a drop of, rather U.S. oil production should see a drop of around, I think, 160,000 barrels per day. That's U.S. output. They also have raised their forecast for global oil demand by not too much, but about 20,000 barrels per day. Do these two statements give you any comfort at all? Do you see the U.S. producing a little less oil in the upcoming months?
Well, when I actually survey some of the major independent producers, they are not as skittish about prices being under $70 a barrel as the media would have us believe. Many of the fracking technologies have had cost reductions. The most expensive aspect of it is water acquisition and water disposal at this stage. The price of chemicals has come down, the price of labor has come down, so they can produce pretty rapidly at anything above $50 a barrel. That's the point at which U.S. oil supplies are challenged, under $50. But at the same time, primary oil is coming out of other areas. So I don't think that the U.S. is necessarily going to be able to dominate prices by having less oil produced here. It's such a marginal difference between the amount of oil that the United States is reducing, if the forecast is correct, versus the amount of increase in demand, if that forecast is correct. And don't forget, China is still on the fence in terms of whether it's going to be growing or contracting. And if China contracts, some of the demand for crude oil, particularly from places like South America, may decline, which would put pressure on global prices in general.
Sure. All right, Philip, thanks so much for your thoughts on how this market's trading up. Well, that's the oil story. Philip, they're saying don't expect the range to break 58 to 61 for U.S. oil.